Alright, friends, pull up a chair and listen close, because the political risk premium on Wall Street just got a forced reboot last Friday night. And it wasn't pretty. This wasn't just some minor glitch in the system or a temporary dip in the charts. It was a total system override. Just this past week, Donald Trump and his business outfits officially pulled the trigger on a massive lawsuit against Morgan Chase. We aren't talking about some small fry regional player here. We are talking about the undisputed heavyweight champion of global systemic banks. And the kicker: they didn't just sue the institution. They called out CEO Jamie Dimon by name, personally, and they are looking for a staggering $5 billion payday. Now, if you look at the legal filing, the official reason is that Morgan allegedly shuttered Trump's accounts due to political bias, which would be a direct hit against Florida's Unfair Trade Practices Act. But look, don't get hung up on the paperwork. Don't get distracted by the back and forth about bank statements and closing letters. As investors, we have to be smarter than the average person watching the evening news. We need to look past the legal theater and see the real pay-to-play price tag hidden behind that $5 billion figure. This is about a whole lot more than just a few closed accounts. This is about who really runs the show in 2026. The fuse for this explosion was actually lit last Wednesday over at the Davos Forum. You know, the place where the global elite gathered to sip expensive wine and tell the rest of us how to live. Let's look at the timeline, because it's a masterclass in how power moves these days. On Wednesday, Jamie Dimon was in Davos, standing in front of the world's cameras, warning everyone that Trump has planned to cap credit card interest rates would be an absolute train wreck for the economy. He didn't mince words. He claimed it would slash credit availability for 80% of Americans, basically suggesting it would trigger a populist disaster. He was playing the banking emperor role to perfection, but by Friday night, a lawsuit was already landing on a desk in a Miami court. That, my friends, is what we call instant karma in the world of high-stakes politics. Trump is using this $5 billion to send a very specific message to Dimon, and more importantly, to every other suit on Wall Street who is still trying to play both sides of the fence. He is telling them that in 2026, the rules have changed. If you want to ride the wave of the massive deregulation policy coming out of DC, if you want to eat the policy dividends of a pro-business administration, you have to pay your loyalty tax first. This isn't just a legal case. It is a total shattering of a major market fantasy that Wall Street could have its cake and eat it too. Up until now, the smart money had this cozy little dream. They thought a Trump win meant a total field day for the banks. They were expecting the death of Basel III, easy mergers and acquisitions, and the end of any real oversight. They thought they could take the profits while publicly bashing the guy who made them possible. But last week's drama just poured a bucket of ice water on that dream. Sure, the administration is handing out carrots, but they are also carrying one hell of a big stick. That stick is the anti-banking executive order. Trump isn't playing around with this one. He is making it clear that banks can no longer act as the morality police. They cannot dump customers just because they don't like their politics, their religion, or their worldview. If this case against Morgan sticks, it's going to turn the entire world of bank regulation upside down. Think about the mechanics here. If banks lose the power to pick and choose their clients based on reputational risk, and if every time they close a high-risk account they get hit with a federal audit or a multi-billion-dollar lawsuit, their entire risk control system goes into cardiac arrest. The flexibility they've used for decades to clean up their books and appease the media is being stripped away from the second Dimon got served last Friday. Every serious investor had to bake a brand new variable into their valuation models. We hear it. Iron Bull Finance are calling it the political compliance coefficient. In this new game, Jamie Dimon isn't the untouchable king of Wall Street anymore. He's the guy being made an example of. This $5 billion might just be the first installment of a massive bill Wall Street has to pay for. The last decade of political posturing. This isn't just a business dispute. It's a deep, decade-long saga of betrayal and revenge finally coming to a head in the most New York way possible. Let's look at the players for a second, because this is where it gets personal. Trump and Dimon are basically cut from the same cloth. They are both quintessential New Yorkers. Both grew up in the shadow of the Queensboro. Both have egos the size of Manhattan, and both believe in the pure, unadulterated law of the jungle. Back in 2016, when Trump first moved into the White House, they actually had a brief honeymoon phase. Dimon was the star guest at the White House strategy forums. People actually thought these two powerhouses would team up to kickstart a new golden age for the American economy. But power is like a high-speed chase. It doesn't like to share the lane. The crack started with that petty, who's smarter argument back in 2018. Remember that? Dimon joked at an event that he could beat Trump in an election because he was smarter and actually earned his own money instead of getting a daddy's inheritance. That's the kind of insult that sticks to a guy like Trump forever. But the real breaking point, the moment it went from business as usual to total war, was January 6, 2021. When Trump was at his absolute lowest, Morgan didn't just walk away. They slammed the door and cut all ties with his entire family and business empire. In today's interconnected world, being debanked by a giant like JPM is basically a social and financial death sentence. Dimon thought he was being smart. He thought he was being compliant and avoiding reputational risk. He chose to side with the establishment to protect the bank's brand. But for a guy who never forgets a slight, that wasn't a business decision, it was a personal hit. Now, fast forward to 2026, and the tables haven't just turned, they've been flipped over. This lawsuit isn't just about the cash. It's about shredding the legal shield that banks have used for years to cancel people they don't like. Trump didn't bother arguing over the fine print of bank contracts. He used his executive power to rewrite the entire manual. Right before the suit, he signed an order through the Small Business Administration that basically bans banks from using ideology as a reason to deny service. He literally told the regulators to delete the phrase reputational risk from their vocabulary. That is a total power move. The shield that Morgan and every other big bank used to protect themselves from controversial clients just got turned into a target. Under these new rules, dumping a client because of their politics isn't smart risk management, it's flat out discrimination. The logic is as simple as it is brutal. If you can't prove the guy was laundering money, funding terrorists, or committing flat-out fraud, and you just shut him down because you didn't want the bad PR from the media, you're on the hook for billions. And for Dimon, it's even worse. He's been acting like the boss of his own independent country for 25 years. But the current administration is reminding him that in this town, the guy with the pen and the badge is the only boss that matters. Dimon is in a corner. If he fights this in court, his private emails trashing the administration will go public during discovery, and that's a PR nightmare. If he settles, he's basically kissing the ring and paying a massive fine. Either way, the independent kingdom of Wall Street is officially a thing of the past. Now, think back to the last decade. Whenever the White House did something Wall Street didn't like, we'd get the Goldman Sachs lecture on CNBC. We'd get a 20-page long-winded letter from Larry Fink at BlackRock talking about social responsibility and ESG. Wall Street used to be a loud, defiant, and incredibly arrogant place. But look at last week. Total, absolute radio silence. No support for Dimon from his peers. No comments from Citi or BofA about the dangers of government overreach in the banking sector. Even the analysts on Bloomberg, the guys who usually have an opinion on everything, are suddenly very, very quiet. This isn't an accident, it's fear. It's a collective realization that the rules of the game have been rewritten. Every giant in the industry just signed an invisible gag order. Why? Because the risk logic has fundamentally changed. It's not just about what the SEC thinks anymore. It's about Trump risk. It's a self-imposed muzzle that has spread through every trading floor from Midtown to Battery Park. Banks are telling their analysts to stay in their lane and focus on the numbers. Nobody wants to be the next name on a $5 billion subpoena. When a powerhouse like Morgan gets sued for a decision they made years ago, every other CEO starts doing some very quick math. Is an opinion on policy really worth $5 billion? Is a tweet or a Davos speech worth losing your government contracts or facing a federal audit of every account you've closed since 2020? Of course not. This is why we created the Wall Street Silent Spiral Handbook. It's a guide to finding the truth when everyone is too scared to speak it. We've been tracking the internal memos and the shift in tone, and we've laid out exactly how to read between the lines. I've put the link in the comments, make sure you grab it before it gets taken down. But the pressure isn't just coming from lawsuits. There's a much scarier, much more under-the-radar weapon being used, the visas. This is something the mainstream media almost never talks about, but it's the ultimate quiet leverage. Wall Street runs on global talent. You look at any high-frequency trading floor, any quant team, or any data science unit at the big banks, and it is full of brilliant minds on H-1B visas. These people are the engine of the modern financial machine. Under the America First banner, the White House holds all the cards on immigration and visa policy. If a bank gets too loud, if their CEO decides to play hero on television, the administration doesn't even have to file a lawsuit. Suddenly, that bank's visa renewals hit a technical delay. Their star math wizards can't get back into the country. Their overseas executives find themselves waiting months for a travel permit. Their cross-border trading licenses get reviewed for national security reasons. It's a quiet, surgical, and incredibly effective way to keep everyone in line. Any HR director at a major bank will tell you off the record, of course, that they are terrified of this. To protect their talent pipeline, the banks have no choice but to manage what their employees say. This creates a culture of duck and cover. If you raise a mid-level analyst and you find something in the data that suggests the current tariff policy might hurt margins, you're going to think twice before putting that in a report. Why? Because you don't want to be the guy who costs your company its visa approvals for the next year. You don't want to be the guy who gets the CEO a $5 billion subpoena, so you bury it. You soften the language, you focus on the positive upside. And that, my friends, is how the information flow gets poisoned. As investors, we are now flying partially blind because the people paid to tell us the truth are too scared to say anything. So, you might be asking yourself, if things are this tense, why is the market still hitting new highs? Why are bank stocks still rallying? Because while the administration is swinging the stick, they are also handing out the biggest carrot we've seen in our lifetime: total absolute deregulation. This is the grand bargain of 2026. We are witnessing the biggest teardown of the Dodd-Frank era in history. The White House is moving to slash capital requirements across the board. Think about what that actually means for a bank's bottom line. If a bank used to have to keep 10% of their cash locked away in a vault as a safety net, and the government tells them they only need to keep 5%, that other 5% is suddenly free money. We are talking about hundreds of billions of dollars being unleashed into the system. Where does that money go? It doesn't go into small business loans or community outreach. It goes into massive stock buybacks. It goes into huge dividend hikes. It goes into the pockets of the shareholders. The message to Wall Street is loud and clear. I'll let you get filthy rich. I'll let your stock price go to the moon. I'll let you operate with leverage that would make a 2007 trader blush. But you have to learn to keep your mouth shut. That's why the market is jeering while Jamie Dimon is suffering. The rest of the industry is more than happy to sacrifice one or two celebrity CEOs if it means they get to feast on the deregulation pie. It's a trade-off they are making every single day. And honestly, can you blame them? Money talks. And in 2026, it talks with a very specific accent. This changes everything for us as investors. In the old days, the world of 2015 or 2020, you looked at earnings reports, interest rate spreads, and management quality. But in 2026, those metrics are secondary. Now, you have to look at political compliance. We have a K-shaped split happening in the financial sector. On the top half of that K are the banks that have seen the light. They are the ones who stay quiet, follow the new anti-banking rules to the letter, and focus entirely on churning out buybacks. These banks are going to get what we call a silence premium. The market will reward them because they have both the profits and the political protection. On the bottom half of that K are the guys who still think they can be independent or principled. They are the ones who still have a target on their backs. Jamie Dimon's leadership charisma, which was once the biggest asset Morgan had, is now its biggest liability. Every time he opens his mouth to offer a thoughtful critique of government policy, he's basically taking money out of his shareholders' pockets. He's becoming a radioactive asset, and the board knows it. So, let's talk strategy. What is the iron bull play here? First, don't try to be a hero, and for God's sake, don't invest in heroes. In this cycle, the celebrity CEO is a red flag. If you see a guy who is still trying to lecture the government on global values or social responsibility, sell that stock. They are fighting a war they can't win with your money. You want a CEO who is boring, compliant, and focused on the balance sheet. Second, look for the quiet performers. Find the mid-tier banks and the boring institutions that are aggressively buying back stock and staying out of the headlines. They are the ones who have figured out the new map. They aren't trying to change the world. They are just trying to cash in on the new rules. They are the ones quietly benefiting from the capital requirement cuts without attracting the $5 billion subpoenas. Third, and this is the most important one, you have to learn to watch the corporate speak. This is the reverse indicator of the century. If the CEO starts sounding like a programmed robot, if they dodge every single political or policy question in an earnings call, or if they start using incredibly vague, bureaucratic language, don't get frustrated. That is a buy signal. It means that company has been re-educated. It means they've accepted the gag order and they've been handed their ticket to the profit party. They are safe in the eyes of the regulators, and that safety is worth more than gold in this market. Look, I know this sounds a bit cynical, I know it feels like we're losing the free market. But Iron Bull Finance isn't about how the world should be. It's about how the world is. The market isn't a place for justice or for speaking truth to power. It's a place for price discovery. And right now, the most valuable thing a bank can discover is how to stay on the good side of the executive branch. The $5 billion lawsuit against Morgan is the funeral for the old way of doing business. It is the final nail in the coffin of the idea that Wall Street and the White House are equal powers. From here on out, there is only one boss in this town. The era of the banking emperor is over. And the era of political compliance is here. If you can navigate this shift, you're going to make a fortune. If you're still waiting for the old normal to come back, you're going to get crushed as a bag holder. We've laid all of this out in our handbook: the specific sectors to watch, the CEOs who are at risk, and the quiet winners of the deregulation boom. The link is in the comments. Grab it, read it, and stay ahead of the curve. Because in this market, the only thing more expensive than a $5 billion lawsuit is being the last person to realize the rules have changed. I'm Iron Bull Finance. Stay sharp, stay quiet when it counts, and I'll see you on the next one.